Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Welcome back, ladies and gentlemen, of course. But as usual, ladies first. It's time for another weekly market recap at the end of a week where finally we have something to talk about for real this time around. Markets moved this week. If you notice, we had a face-melting move to the upside in Bitcoin. Gold kept on moving after stalling for a week or so. And even other metals actually followed up. The stock market moved. Everything pretty much moved. Even currencies, whether you believe it or not, they usually never move, right? But, you know, let's get rid of these because fortunately, this week, there is not a lot to talk about from the economic calendar standpoint. I mean, there were a few data points about the housing market, industrial production, but I'm not really a huge follower of them, mainly because I'm not involved in assets which would, you know, greatly impacted by these type of data points. You could argue maybe, yeah, the S&P PMI, but it, you know, it was the flash, so I wasn't so enticed in checking all the details about that. So, you know, good news for you. We can get rid of it completely and just step into the charts immediately this time around. So let's start out with the DXY, which, again, at the end of the day, do you remember what we were saying? Look, this level right here, it may not give in right away. Expect a little bit of support. But, you know, especially with all the news, all the statements that we had this week, finally it gave in. Now, again, I'm not saying, right, that I do truly believe that this is the right reaction that the market should have, especially, again, let's address the elephant in the room right away. The big news of the week, of course, was Scott Bessent coming out and saying they're going to double down on the treasury buybacks. But more on that later. But just remember, this is kind of the main theme which is driving or has driven market moves throughout this week. Again, I'm not saying that's the real underlying fundamental reason, but it seems to at least be the catalyst for it, right? Then we're going to look at the charts and say many different things like, for example, yeah, I mean, that was the catalyst, but wasn't the market already poised for that type of a move? Yeah, so, you know, the video would be on that bottom line, all right? So the XY finally came back down, and we are basically in the middle of the same range we have been for the last year and some at this point. So nothing is really changing, right? People look at every single daily candle and they assume the dollar will collapse or the dollar will skyrocket. And, you know, at the very end of the day, over the last year, it's not going anywhere. Which, by the way, you could assume, I mean, if you are a currency trader, or especially if you are a position trader, I don't know why you should be, but if you are, you may say, oh, okay, that's boring. But, you know, throughout the lenses of a central planner or a treasury secretary or a Fed chair, whoever, right? That's really what you want to see in currencies. You want to see a currency being relatively stable, which is why we have all these institutions trying to manage, or quote unquote manipulate, if you are particularly conspiratorial, the FX market to drive those currencies up or down. But, you know, at the end of the day, what do you want for, in order to guarantee stable trades globally? You want currencies which, relative to each other, stay as relatively stable as they can. So, you know, I guess if you think about the US administration, Trump wanted what? A weaker dollar? Well, I mean, it looks like he kind of had it so far, right? It went down and it was particularly stable to the downside. I'm not saying that this is gonna be a permanent state, right? I'm not saying that just because an administration, a particular one, It may be the US, it may be Japan, it may be Europe, whoever. Just because someone wants something to happen, it's going to happen. And we have seen that example many different times where the Japanese yen, right? So now that we have transitioned to these at the top, let's start up at the top of the screen. So euro obviously came up, and it's basically the specular image of the dollar. We also have the same type of short-term top in here, which is now retested. Same as we had that short-term base, which was built up, originated the move up, and it's now retested at the top of the base in here, right? As for the British pound, again, it looks a bit better than the euro. So again, it's been a theme for a while now, relative strength into the British pound for now. We see how long it can go. I would say, up until it goes. So you should be relatively more bullish on the pound and a bit more conservative with upside targets for the euro, right? That's just the chart speaking there. The Canadian dollar came all the way back up, right? So it looks like we are deviating away from these pivot right here. Once again, you see we deviated to the upside, then to the downside, then majorly to the upside, back into it. Another deviation back to it. So again, wide ranges in between, 135 and 140, 142. But we tend to gravitate around this one. So we don't have that escape velocity yet. And I was reading that particularly in between Canada and the US, they just had some issue in these negotiations about, trade agreements and whatnot. As always, you don't know who is to blame for it, because of course the Canadians are saying the US changed the terms at the very last minute. The Americans are saying the Canadians just walked away from the table. So who knows, right? We've seen these type of negotiations too many times at this point. Like with the MOU. Are we negotiating with Iran? Are we not? Are we bombing? Are we talking? That looks to be the MO of this administration as a whole. Saying something, doing something, then denying it, then backpedaling. So, I don't know. Maybe there is some sort of a method to the madness there. But, it generates a lot of volatility, of course. Not only markets, unfortunately, as we've seen if you look at whatever geopolitical type of newspaper, right? The Swiss franc, it came up. Together with all the rest, obviously. The only one which didn't have follow through to the upside this week was the Japanese yen, which is getting back and approaching the 160 pivot once again. So, this is why I was saying, usually if it was just a BOJ, massive skepticism about their ability to actually do something relevant and impactful for the mid to long term. Now that we have Bessent and the US involved, maybe let's just wait and see. But even this one, it looks like so far, it stayed above 157, 56 for what? A week? And then we are already at 159, more or less. So, I don't know. Scott said there is a huge commitment on the US side of things in order to help Japan, rescuing the currency, because obviously, not my words, right? But Japan is a very good ally, right? And you can always trust the Japanese, with the exception of Pearl Harbor, of course, right? So, we'll see how it goes on. For now, I would say we are looking at a little bit more of the same over and over again, right? Huge intervention, and then market forces are taking over once again. Which again, we will see another example of it when we are going to check the yields, right? And how they move this week. The other currencies, pretty much the same. Chinese yuan keeps on climbing to the upside. And look, if you zoom out, just, it was a while we weren't zooming out on this one. It's steadily going up now, right? Now, again, a lot of people assume that the Chinese yuan was doomed to do what? To keep on plunging to the downside, because the Chinese were willingly devaluing the currency in order to gain traction on the global trade stage, right? It's way easier. Anyway, it's way much more convenient to buy Chinese goods if their currency is going down and down and down, because for you, the importer, in this case, it's cheaper and cheaper and cheaper, right? But that also implied that at the same time, all China was doing was to collect those profits. Could have been in euro and British pound, but mainly in dollars, right? If you are trading internationally, the majority of the transactions are settled in dollars. And again, more on that later, right? So they were recycling then those dollars into the US Treasury market. So what do you do from a currency perspective when you swap the profits into the US Treasury? You sell yuan, you buy US dollars, and then with the US dollars, you buy the Treasury. So if they are now divorcing from that dynamic, maybe because they've seen what the US did to Russia in 2022, again, another talking point for later, right? I'm just trying to lay out the foundations for what's going to come mainly at the end of the video, right? Obviously, you're going to see the Chinese yuan appreciating against the dollar, right? At a time where, of course, the dollar is going down pretty much versus everything. So it would just amplify the move, I guess. The rest, it's pretty much following along to a lesser degree. Obviously, South African rand, it came up again. The Indian rupee, it's the kind of the outlier there, because it's still particularly weak around the lows. It's going sideways for now if you look over the last 2-3 months, but it's going sideways after being down and down and down. So not cool, I guess. Brazilian real, again, it was maintaining this momentum up, right? And we had this pullback when the initial bounce faded, then it tried to build up to the upside slowly but surely, and then again it looks like this move, which was particularly efficient, very ordered, it lost traction, and for now we are just stuck in a range in between 19 and call it 19.8, whatever. You could round up to 20 if you want, but still we are in this range. So up until the point we don't break out or break down off of it, don't have any major type of bias on this one, right? Australian dollar came up, of course, but again, move up, pull back, another move up, failed, back, the low side of the range. Now we're back at the upper side of the range, so let's see what's going to happen next. The bet would be probably a pullback, but considering how the DXY moved this week, I don't really know if the rest of the foreign currencies will keep on the momentum. Maybe, but about the DXY, if you check this one right here, let's see if we can bring it up. Not checking this in a while now, which is basically, let's see if I remember the name, trade weighted US dollar index. So again, it's a different measurement of the dollar relative to other currencies, right? And if you zoom out, you see that, it's pretty much in a range, right? Kind of like the DXY itself. Although, it is in a range, but still at a higher level, right, compared to where the DXY is. If I can just detach the charts a little bit, let me see. There you go, right? And you see high in here, lower high in the DXY, and then lower low into the DXY are still hovering around the lows for the trade weighted index. So, it's just another measurement. Another one which you can find on the Fred database, it's the broad dollar index, or some name like that. I mean, if you check it out, you will be able to find it. But just to say that, again, the DXY, it's just measuring the relative strength of the dollar, mainly against the euro and the yen. All right. Now let's move on to juicy stuff. Let's have a look at Bitcoin, which you may say it was anticipated, but for me, it wasn't, quite honestly. I'm going to call it spade to spade. I absolutely wasn't expecting this type of dynamic expansion to the upside. And actually, I was just wondering, I mean, if the stock market is performing so well, or at least, keeping up the gains that it achieved, why is Bitcoin not following? Since it is considered, or at least for me, it is considered a risk-on asset. It's actually the king of risk-on assets. And again, call it what you want, the catalyst might have been what Bessent announced. If that is, right, I would be a little bit more worried. I'm not saying that just because that's the catalyst for the entire move, that should be given back completely, all right? But I'm just saying it may be the wrong reason fundamentally. That being said, I've seen many moves in markets being actually initiated for the wrong reasons, but, maintaining their own momentum for a while before the market finally figured out, oh, well, no, that's wrong. So we need to reprice. I'm not saying we're going to see that in Bitcoin. Actually, I do think if this thing get traction, usually, especially in the past, it was particularly hard to tame it. It's like, once the cat is out of the bag and these things starts to run, it's hard to tame it. If you zoom out, although, right, now let's go on a weekly time frame, right? I mean, are we back into a bull market? I'm not going to lie. It looks promising, obviously, all right? Because overall, we came all the way back to this area, which was, on a macro scale back in 2021, in between 60,000 and 69,000. It was an area which was interested many, many times. It was a selling area in the past, and then it was some sort of a flipping area. Instead of heavy selling, we started to found buyers at and around those levels. And, we just circled back into it after the huge pump in 2024. And, we stalled a while, and then it looks like we are now trying to break out of it. At the end of the day, on a weekly time frame, this is not, right? This is not a new weekly high yet. We are still below this high in here. So, if you're looking at it from an investing standpoint, just, wait a second, especially because on an absolute base and on a closing base, right? We are still operating on a low, lower high, lower low, lower high, lower low. So what's going to be? Can we push above 84, right? And making the first higher high in what? Since October 2025, right? Or are we going to see rejection here, right? It's probably going to take a while to figure out. Maybe another week, considering how volatile it can be. But, for now, enjoy the gains. There were two levels in here, smash through, in here, smash through. I was expecting, to be honest, even by looking at these move developing, I was expecting a little bit of resistance in here, just by the nature of it. It's an old apex, right? But if you consider fractal nature of price, when you check the entire thing, the entire formation, the entire redistribution, is this as a whole an apex? Yeah. But inside of it, would you say it is the ultimate apex in here? And it was never retested if you check, So maybe the market has a tendency to revisit points, pivots, and levels which have not been retested in a while, just to check if everyone is on the same side of the thing. Also, this level right here was, it was relevant on the downside. Break, start a step, down, and resistance, support, broken, and then we go down. So, and even if you zoom back, it was the origin of this massive move to the upside. So, I don't know. I've been keeping this level here for basically April 2025. year and a half, and it looks like still to this date, it's holding a little bit of relevancy, at least for a minor reaction so far, right? For the future, or the foreseeable future, the coming future, I would say if we can maintain these levels, I mean, you may see a little bit of a drawback, maybe, but let's see, this level right here, or at the very least, this level right here, okay? If we can maintain these levels, right, I would say we're still on the go for an upside move. Why do I say that? Because if you run off of the assumption that this is a new bull market and you just, you don't need to be a quant in order to see that. Just look at how price moves in a real bull market for Bitcoin. I'm just going to keep, I'm going to stay on the last one, right? Let's stick to that one. That around here, there was the FTX debacle, right? And then, we started to run in here. Notice how we never tested back into the accumulation which marked the bottom. I mean, yeah, there was a pullback, absolutely, but it was never a clear retest of the previous bottom. And then we ran again. And then, of course, we go sideways. We pull back a little bit, but look, we tested back into what? Into the highs of the previous consolidation, aka the previous shelf. We never really retested the origin of the move. And then again, we went higher again after this period of consolidation. And look, you see a retest of these levels, of this huge consolidation? No, it just went and it kept on drifting to the upside. Now, in this case, again, we went kind of sideways for a while, expansion to the upside, retest of what? Kind of the highs of that tiny little shelf, but we never really retested the origin of the move to the upside. So, in this one, again, same thing, accumulated a little bit. It goes up, never really pulled back to the previous highs or nowhere near that. So, I would say in a real bull market, even if you check this one, tiny little consolidation, it goes up, massive explosive move to the upside. In order to see this point retested, which was February 2024, you needed to wait, essentially August 2024. And the market ran and stayed elevated for a while before actually coming back down into that. That was basically a huge pain in the ass for Bitcoiners, I guess. But eventually, this consolidation as well was resolved with a move to the upside. And check again, once we break out, we never retested, not even the highs. It just went, right? The first time we retested it after breaking out of them in November 2024 was in April 2025. So again, I wouldn't count, again, the assumption, the caveat is that this is the start of a new bull market. Right? So assuming it is, I wouldn't count on a deeper retest, right? So just for the sake of it, this is how the asset tends to behave when it goes for those huge runs that you've seen in the past. So if you are waiting for a retest here, the 67, never say never, but I would say history is kind of speaking a little bit against it, which is why, although if it was a normal asset, it would feel a bit like chasing it. But, being Bitcoin, again, if we can be stable for a while in here and not breaking back below these levels, maybe this move actually have legs, right? Just quickly, do I care to check MicroStrategy? No, I don't. We checked it last week. I think even Stretch was kind of getting back on par. Let's have a look instead at gold, which extended the move to the upside. And, gold traded very technically. There were two scenarios, right? One was to wait for a potential pullback into this area right in here, or maybe these highs, right here, okay? Never gave one, right? The alternative, although it was, again, buying at higher prices, but the alternative was to wait for the market to actually chew through these resistance, reclaiming this old range, and then trying to buy an eventual retest of the this following level being broken up. It looks like it did. I mean, we broke out, right? And, you know, we retested and, you know, good reaction to the upside. I mean, it was what? 4,510 up to $190 move for gold in 2 days. It's not bad. So, you know, could say played out. Too bad. Didn't give that, you know, much pronounced pullback. Was very nearly as a pullback in here. But yeah, one way or the other, you know, one of the two scenarios actually played out. So what's next? I mean, it's normal to find resistance in here, I guess. If you look at this type of a short-term top in here, right? I would say it's not unusual to see a little bit of a stutter step in here, but all things considered, I would say we may test a bit higher. Yeah, in the high 700s, right? Again, if the momentum is real, right? There's nothing bad, right? There would be nothing bad even if we pull back a little bit again, just to make sure this level is actually finally broken up, right? And then we try again higher, rather than just shooting straight back down into this one right here, right? This old area. Okay, so just for the sake of it, up until the point you don't see this move being faded, price getting back below this base. Oh, I mean, it's a shelf technically, but yeah. If you don't see that, I would keep a bullish bias on gold for now, right? And again, even this one right here, people are now saying, oh, look, there was that announcement from Bessent, money printing is going brrr, and gold immediately felt it. But is it? Because it looks to me like gold was running from what? Beginning of August. So either you do believe that the gold bugs actually sniffed that type of action from Bessent 2-3 weeks in advance, or again, what we've seen as for, you know, the news was just another catalyst to fuel these move to the upside even more. But you know, saying that tiny, I mean not tiny, but that single little thing was the all and be all behind this move, I find it hard to believe, right? Fundamentally, gold has never been, you know, the fundamental thesis was never defeated, right? Sure, we had a huge pullback because of what? Dollar scarcity, right? And then we got the energy crisis, so oil spiking to the upside. People needs what? More dollars to buy oil at a higher price. So what do you liquidate when you need more dollars? Either treasuries or gold. And, you know, at the end of the day, it resolved that consolidation to the upside. It kind of, you know, fixed that overbought condition, and it's trying again higher. We'll see. Again, it's kind of like in the past. We are going to reiterate a lot of sentences and you know, would you call them axioms? No, not really. There is no axiom in the markets, but some of the same concepts from the past. I would rather see an asset going up and up and up slowly, rather than being parabolic, because, you know, parabolic moves, they expose you to what? To this type of behavior, right? Or, you know, even this one right here. So if it is a steady march higher, it's even better for me, right? But for now, whether you are a Bitcoiners, whether you are a gold bugs, whether you are one of those, again, quote unquote, conspiratorial type of people which are still thinking the government, it's fucked, it's broken, it's insolvent, enjoy your moment, right? Or at least enjoy the gains, right? So the other precious metals, yeah, they responded as well, kind of like gold. Curiously enough, the only one which moved in a little bit of a counter tendency. Again, let's try to measure the words carefully there. It's not that it collapsed. Actually, if you look at copper, we closed where? Well, we closed where, pretty much where the last week actually opened up. If you zoom out on the weekly time frame, it's some sort of a doji, so didn't really go anywhere this week. And again, structure, get tiny little bounce in here, very good, right? And good reaction so far. So now you need to see if you're going to have continuation. And it's going to be tied up to what? Well, AI, right? AI build out, all these electronics, hardware, chips, materials, whatever, or cables, right? But you're going to need copper if you're going to building all these data centers. So I think copper is on the go up until the point you don't see a shift in the narrative about the AI build out or, CapEx being revised. And again, that's a whole different topic, because what could bring CapEx to be revised lower? The credit market being too crowded, too much supply. Again, another theme for later, right? All these hyperscalers starting to have issues when it comes down to their returns or to the cash flow, the balance sheet, the off-balance sheet, the debt, whatever. But for now, up until the point that doesn't happen substantially, I would say I would keep on maintaining a bullish stance on copper. Now, I don't know why, but I have 2 times the Bitcoin chart. Strange. Don't know really why is that, but again. So there should be oil somewhere. So maybe this is it, right? Yeah. So let's have a look at oil. There you go. Something actually changed, and I don't even remember when I did it. But so it wasn't, at the end of the day, it wasn't another lower high. And so we are back in this range in between 78 and 90, I'll call it low 90s. To be fair, it looks constructive, right? It really looks like, it wants to get back into the 90s. Will it? Well, again, same kind of riddle. Once again, what's going to be in the Middle East, right? Because it looks like for now, even on the US side of things, there is this, I'm not saying, it may be political willingness to tune down things from the military side of things and move to a more economic type of warfare, which, by the way, I never understood why they didn't do it since the very beginning. Instead of bombing a country which is really huge, which is 90 million people, I guess, yeah? So why don't you just choke them off? But I don't know. I'm not military strategy, but, it looks like they had the right idea, right? After the fact, after the initial 2 months of the war. Yeah, bombing doesn't work. So you know what? I'm going to blockade your own blockade on the strait so that, yeah, you can blackmail the world, but I'm going to cut you off of everything. So no more oil sold to China, no more money coming in. And, at the end of the day, you're not going to have more money to pay the troops, the militaries, whatever. The country will collapse. People might start revolution, although we've seen how many of these attempts were actually suffocated. So I don't know if people are really willing to do that yet. But again, strange developments. If you just rewind the entire thing, the entire chronicles of these conflict, I don't know. It's like, again, it's everything and it's the opposite of everything at the end of the day. It's 2 narratives. It's 2 sides talking past each other and talking completely different topics or reporting completely different facts. So I guess just another side of the war, the propaganda, right? But as for oil, again, for now, I need to to be a little bit more bullish, maybe considering how price is moving, right? And we'll see if we have any type of news which is going to be a tape bomb and may bring the price completely the other way around. But if I'm just looking at the chart, to me it looks constructive enough. I've been wrong in the past. Just look at Bitcoin last week. So don't take it for granted. But I'm just expressing a view which is present now and could be completely opposite next week if the market suggests so, right? So let's have a look instead at the stock market for the week. So if we zoom in and we start to look at what happened, we start out on Monday and immediately we started selling off. Right? Monday was a down day completely. No relevant pullbacks, right? It just started to sell off at the beginning of the US session, mainly. Overnight was particularly sideways, and then we just sold off. We kept on selling off even throughout Asia, so transitioning from Monday to Tuesday. And again, we sold off in London, and then we kept on drifting lower in the US session. We had a little bit of a bounce on Wednesday, and I think this is where they made the announcement. Yeah, because it was around just a little bit later compared to lunchtime where I do live. So yeah, I was in here, right? Bessent came out announcing that tiny little thing. The market went up and came all the way back down and then up again, but it sold off eventually. It closed as an update, sure, but the market had a little bit of time to digest the news, and then overnight flat, and the following day on a Thursday, London started to sell off, right? A little bit of a pullback, and then hard selling into the US session, which initially went sideways a little bit, even in the S&P. Sorry, the Nasdaq, as you can see in here, but it closed on new lows for the day. And Friday was just a little bit of a pullback to a bounce to the upside, but at the beginning of the New York session, the Nasdaq got back toward the lows. There was a bounce again, so at least the daily lows were defended. Okay, but it closed on a little bit of weakness, right? That bounce wasn't a complete reversal. We tested back into the open, kinda, and then we just came back down again. And so S&P maybe a little bit better because that bounce actually brought us to new high, at least for the day. But again, it's not enticing so far. So if you look at the weekly action like this, very zoomed in, you may say, oh, so that was a huge sell-off. If you strip away Wednesday, the rest of the week was just selling. Yeah, it was. But when you zoom out, what you see is that, the S&P basically did that thing that we were anticipating. It was looking particularly bullish last week, Friday's close, right? What was the caveat? Got these lows, right? If you break those lows, you're probably going to retest back where? Either into this consolidation right here or previous highs, right? So basically where we are right now. Actually, we are below it right now. So, nothing prevents this thing to actually, maybe next week, early in the week, maybe going even deeper for a further pullback. But, for now, what we got what? Peak to trough, so far, 2.3% correction, right? After, again, peak to trough, or trough to peak in this case, after a 7% rally. So, they may be normal, right? Now, if you check, let's say the Dow, it's even better. The trend is to the upside, new all-time highs. We are testing back into old highs, and so far we're bouncing. Same for the Russell, new all-time highs in here. We are testing back to, kind of creating a range now, right? But holding and maintaining that previous breakout level. If you imagine the Russell was drifting down, we broke out. We are now retesting kind of the area where we broke out off of. So, I mean, the only exception is the Nasdaq, which never made new highs for the year, right? And we are back toward, it's kind of the same, right? In the sense that we are here basically. So if you imagine this range right here, this area, this level, right? Range, broke down, retested, down we go, reclaimed, tested back in, support now, up we go. Now we are at the same level. If we can maintain this level, I would say, sure, relatively speaking, the Nasdaq would remain weaker than all the rest, but it doesn't really mean that we are seeing a bear market yet, right? Could this be the beginning, right? The initial stage of a macro reversal? Maybe. I don't know. Even if it is, it's too early to tell. And again, my job is not to call for tops, especially macro tops or bottoms, right? What I've always said, and I'm still a subscriber of it, is that overall, as for the broad market, I would expect subdued returns, especially in the S&P, if you don't get the Nasdaq to participate, all right? Just because of how the market capitalization weighted index work. There are a few stocks in the Nasdaq, like I don't know, Nvidia, Microsoft, Apple, Google, Amazon, Tesla, Meta. They are a huge chunk of the index. If they don't participate, it's going to be hard to see the broad market, the main benchmark, to, I'm not saying to go up, but to go up significantly, right? The simple fact that you're seeing, kind of like from a market capitalization standpoint, if you're seeing the leaders struggling a little bit, but overall, the index being what? Still made new all-time highs recently and not even got back below the previous highs, it means that the market is rotating. There is a few sectors in the market which are suffering a little bit, which are underperforming. God knows they are just those sectors which in the past helped returns to be exuberant, sure, but the rest of the market, it's not really falling off a cliff. And if you go on to something like this, right, this is a 1 week performance. As I say, you see that Microsoft, Nvidia, and all, the semiconductors, tech in general, like Meta, right, down 7% this week. I think they are also, facing a low, what do you say? How do you say that? I mean, they've been brought up to court for whatever type of bullshit reason, like, social media create addiction. When I was looking at the news, I was like, and you sue a company? I mean, tobacco, booze, fucking hell, even video games create addiction. You're not suing every producer of liquors or alcoholics. You're not suing every software house which is producing video games, right? And I can speak for, for myself, because sometimes I get onto some of these, those RPGs which are really long with a lot of mechanics, a lot of personalization, character developments. You can create your own character. I get lost in them, right? Just, I got like 600 hours in Fallout 4, for instance. So am I suing Bethesda because I got addicted for a period to Fallout 4? I mean, no. And you want to know why? Because I'm an adult. And at a point, I'm going to say, shit, this week I spent 35 hours sitting on this chair playing this fucking video game. And I do realize now that I could have done so many fucking different things and more important things. And I need to do them now all together because I wasted time on this fucking piece of shit. So I can afford to be childish for a week or two. But then I remember I'm an adult and I got responsibilities. I don't sue a company. All right. So, I mean, I don't know. It looks to me like for every problem, you just sue the company. Sure, okay. Now we'll see how that plays out. But, you know, sorry for the rant. But, you know, I don't really get it, right? I don't really get it. We create so many things which are addicting, and then we moan and bitch about we are addicted to something. I mean, okay, you know, all right. Have it your way. So getting back to serious things. So you see that overall, you know, there are the where sectors, like for instance, this one, software and applications, healthcare, energy, right? I don't know why Tesla, but to some degree Tesla. This one was a credit service, up a tiny bit. Financial data up, although, you know, banks were down. So mixed bag results, right? Which overall bring you to what? To see the main benchmark still being relatively up and, you know, in good shape at the end of the day, and just, you know, the Nasdaq being a lagger. Now, there is still that topic we went off of like a month and a half ago about, you know, when you have the Nasdaq underperforming the Dow Jones for a specific number of days, you are in a bear market 3 months after that. And the delta, I think it was when the Nasdaq is underperforming the Dow, and the delta gets up to 5% for more than 10 days, you're going to have a bear market in the next 3 months. You're halfway through that, I guess, if not a little bit more than that, almost 2 months. So again, this is why I'm saying, is it the initial stage of a bear market? I don't know. I'll tell you in September, or maybe, you know, at the beginning of October, depending on how price moves and how that tiny little piece of data works out. Okay. So, you know, I wouldn't be too worried over things for now, as for the stock market overall. Okay. But, you know, as I said last week, considering where volatility was, the VIX was the 14s, right? It's not a bad time to buy insurance, which means buying puts. So, you know, just pick your poison there. Sometimes you buy puts and then you moan and bitch about them because they expired, worthless. That's what you want. If you hedge yourself on a long-term type of play, you would like your hedge to expire worthless, because it means that your main thesis on the asset is still playing out, right? It's like, and again, here's another thing. It's like, do you have a house? Sure. Do you pay any type of insurance on your house, like against fires or earthquakes or floodings or hurricanes or whatever? Are you moaning and bitching about it every single year because you pay the premium and then the fire never came, or the hurricane never came, or the earthquake never came, and your house is still intact? Well, you don't moan about that. You pay in the case that happens, but if it doesn't happen, you pay the price just for protection in case it happens, but you don't fucking moan about your house not being destroyed by a earthquake. Have you ever heard about anyone saying, "Ah, gosh, what a terrible year. I subscribed that insurance, and fucking hell, I saw no hurricanes burning down my house." But burning, I mean, tearing down should be a better analogy. No, I never heard anyone talking like that. For a reason, because whether you believe it or not, people have still common sense, right? So, you know, that was the volatility, which ticked up maybe a little bit, but nothing major yet. So I guess the thing about volatility, while we'll have a look at the same type of ratio in between mags and momentum, which is still looks like favoring the mags, but yeah, its momentum's fading, I guess. But when you look at in blue, it was the RSP, so the equal weighted, which is still relatively near its all-time highs. So again, market capitalization weighted index, so the S&P in black pulled back, and Nasdaq in red pulled back even more. But again, just testament of that rotation, equal weighted still at the highs. So, you know, not bad. That's not bad, to be quite honest. Semiconductors, they rejected that type of a neckline that we drew, so no reclaim of that. And they stayed a little bit more tame, so no immediate upside here, right? That's fair, I guess. But no, getting back to volatility for a minute. Do you remember? I think it was either the 3rd or the 4th week of July. All right, we were looking at a chart which was, basically talking about the what was that? The implied correlation, right? The implied correlation. If I, fucking hell, what's that bullshit? Okay, this one right here. And it was on the floor, right? And even, throughout the following weeks, not to mention last week, you remember we were saying, why is the VIX so low? Most likely complacency. So when you have the VIX so low, the volatility, it's tamed, right? It is subdued. And what happens if you have low volatility and a very low implied correlation? It means that you have a lot of dispersion. So the market, if you think about the broad index, right, it looks calm on the surface, right? But underneath the surface, you see many different stocks moving in many different opposite directions, which is why the correlation is particularly low. If you have the VIX spiking, when a correlation are here, you may have a reversion in this chart, which means that all of a sudden correlation will start to push toward positive territory in a period where the VIX is maybe spiking to the upside. And we know we are getting into a period of the year where historically, seasonality speaking, the VIX is a little bit higher than normal, right? So that would open up the door for a little bit of an air pocket, right? And the market could slide down a little bit. Plus, still on the topic of volatility, not to mention, we started this week and we got, again, low VIX and record low correlation, right? It's the same coin, right? So it tells you that there is the risk for a mean reversion type of event. If things start to swing from one extreme side of the spectrum to the other, right? And this week was also on Friday, it was OPEX, so option expirations, which, it just, I'm not going to read it all, but we talked about it a while back. But if you think about what happens when a lot of options positions, right, needs to be, they're going to expire, so they're going to be unwound, right? Up until the point you have them, right, you have dealers intervening or participating in the market, right, to do what? To hedge themselves. And again, read the paragraph. I'm not going to read it all because it's much better if you read it in plain English rather than hearing it from me, right? But the bottom line is, up until the point you have all those positions still intact, still in the books, you're going to have the dealers doing what? Participating in the market to hedge themselves. Now, if you find yourself in that situation where the gamma environment, again, just the second part right here, right? The gamma environment is positive, you're going to have what? Subdued volatility, because the dealers are going to sell in an upward tape and they are going to buy in a downward tape, which means that they are going to tame volatility down and they're going to create conditions by which the market will have difficulties going for really huge and hard expansionary moves, right? While instead, if you have a negative gamma environment, the dealers will behave the opposite. If the market is rallying, they will need to chase the rally and to buy into strength, right? If they buy into strength, they're adding fuel to the move. Or if you're selling into weakness. But again, it's a little bit a bit more precise if you're reading it. And again, you can always ask like ChatGPT or Grok or whatever type of tool you're using. But, getting into OPEX, that was another dynamic that you supposedly are going to lose, because all those positions which were causing the dealers to behave that specific way and maybe taming volatility, if they are unwound or they expire, the dealers won't have any reason to keep on, I don't know, like we were saying, buying into a falling market or selling into a rising market. So you open up the door for a little bit more of a directional move intra-week. And again, even the week after OPEX, historically, you see a little bit more volatility, and then things tend to get a little bit more stable after that, while all those option positions and books are filled up again. So, considering all the things, is it unprecedented to see a little bit of weakness, considering that OPEX, the gamma environment, the seasonal period of the year, the huge and sharp move to the upside that pretty much every market's had? Is it normal to see a little bit of weakness or a little bit of a pullback? I would say not necessarily, right? So, again, that would be it as a whole. For next week, I would say we are at a little bit of a decision point to some degree. It's not a huge decision point for the next 9 months or, 18 months, but I would say, if look at the ES mini here or the S&P, if we trade back below those highs and we get trapped again in that previous range, then I would stop being bullish in the short term. Same for the NASDAQ. Again, I said it already. If we start to close daily candles below 28,500, to use round numbers, it could be 28,600, it could be something like that. But you know why the area is important for me? Again, it was a range, deviated below. So up until the point we can hold the former lower side of the range, I can't be overly bearish, right? Plus, if you zoom out, a monthly time frame, trading below that 28,800, what would it mean? It would mean that the monthly candle starts to be red, or in my case purple, but again negative, right? We would trade below the monthly open. Now again, we just have, I guess, 1 week of trading. Yeah, 1 week of trading in August. So next week is probably going to be particularly telling. I'm a little bit agnostic at the current moment in time, again, because of seasonality, because of, the midterm elections looming. So I'm not bearish, obviously, in the sense that I'm not saying we're going to enter a bear market and we are going to pull back 30-35%. But at the same time, as I said last week, this is not a spot, or that wasn't a spot where you want to add risk, right? And I talked about trimming the winners, especially if they were huge, maybe buying protections. But so I'm agnostic, directionally speaking, and, or maybe a little bit more neutral getting into next week. Overall, I think the long-term trend, it's still intact, right? I don't see any reason, if you're looking at the medium to long term, to be worried about these markets in general. But, short term, a little bit of volatility, a few fluctuations, a potential, can't believe I'm going to say that, a potential window of weakness opening up. Yeah, maybe. But is it a death sentence for the market? No, I don't think necessarily. We will need way more than that. Like, for instance, we would need to see credit spreads starting to really crack up to the upside. Now, sure, the junk, it's already doing it, sure, but the Bs, not yet. So up until the point I don't see that, I'm not sold on it, right? So that would be it for stocks. So let me check a little bit of my notes and we will get back to yields and the bonds, all right? So let's start out from the basics and let's have a look at what yields did this week, all right? Now, as you can see, they keep on doing the things, like the 2-year was still drifting lower a little bit. The 10-year was still drifting higher, same as the long bond or the long bond yield, right? Then, comes Bessent on a Wednesday and you see the 30-year yield collapsing down. I mean, for the day, obviously, it's not that it was a huge reversal on a macro scale, but kind of a decent move for the yield on the long end, like 1.8% in a day. open to close. It's not a move that you see every single day, right? But then what? Then, following 2 days, the long bond yield was basically back where the dump actually started. The 10-year was actually higher than that. And even the 2-year started to come back up. So I've seen many people, especially if you check Twitter, they are all calling for many different things. I mean, not all, but gotta be honest, that there are a few people which are actually trying to understand and having a structured, honest, and transparent conversation, sure. But, the usual, how do you call it in English? Pundits or whatever, the prophets of doom and gloom, they're always out there, right? And the main narrative on their side, at the very least, it's, see that? They need to intervene, right? They need to step in, and they're going to come in printing a hell of a lot more money and even starting implementing yield curve control. So, again, I was, as soon as he came out, posted the announcement, and my comment was waiting for Twitter to call in yield curve control in 3, 2, 1, whatever, right? Because that's the natural reaction that people usually have when they see that. So let's try to define what was and what wasn't to start out. So this is the problem, so to speak. We are basically increasing, we are doubling down on the amount of buybacks, right, that we are going to perform on a few specific maturities along the curve. Namely, the long duration. So whatever is above the 10-year duration. So 10, 20s, 30s, whatever, right? And we are intervening so much that we are stepping up our game from 2 billions up to 4. And if you think of the size of the outstanding debt out there, I think the 10-year alone should, I think it should be like, I don't know, 5 trillions maybe. I don't know. So first of all, you look at the numbers and you say, sure, but that's not even a drop in the bucket. How can it move the needle? All right. So the other, so immediately you start to apply a logic and you say, okay, so maybe it's the same kabuki theater, right? So maybe they're just trying to signal something, as they did with the yen intervention, and we've seen how it ended up, right? Because you can't possibly believe that 2 billions more will move the needle, right? Then again, this is just a start. I mean, they are going to increase, they are going to ramp higher the program because they will need it. They're going to have no other choice. Maybe, who knows? I don't know if in another 12 months, instead of 4 billions, it's going to skyrocket it up to a few hundred billions. I don't know about that, but I'm just saying for now, that was a little bit of an overreaction. Then you need to remember, by the way, that thing is not new. It's something which was already happening in the 2000s under the Clinton administration. Now, I don't know if a lot of you are actually old enough to remember Clinton, right? I was a kid back then. I mainly remember it for all the backlash, the scandal with that secretary, the assistant, Monica Lewinsky, whatever. But and I remember him for the claim about, which basically won him the elections, right? It's the economy, stupid, right? Maybe one of the smartest thing I ever heard a politician saying. Not saying that I was sympathetic toward him, but back then I didn't even care. But who knows, right? So it's nothing new. And again, if you start to read, mechanics may be different. Comparing then to now, the environment is different, of course, but the reasons kind of always the same, at least what is stated. The primary goal were to enhance the liquidity of Treasury benchmark securities. Okay. And you fast forward to 2024, right? And what do you know? Even Janet Yellen was doing it. And again, the purpose aimed to support liquidity in segments of the market that had become less active. Okay. So, at the very end of the day, what are we talking about? Is it QE? No, absolutely. It's not. Is it yield curve control? No, it's not. Is it what then? It's just debt management at the very end of the day. It may be a signal, all right, for those which are trying to get rid of a few treasuries. It's a way to say, well, we are here. If you want to sell those treasuries, we will take them back, right? But it's kabuki theater. The numbers, they don't add up to have any meaningful impact on the bond market so far. And look, if you care so much about the definitions, why it's not yield curve control? Because when you perform yield curve control, you have to target a specific yield. And you're going to say, I'm willing to buy whatever amount, whatever size of treasuries I need up until the yield gets back to that specific number. It's not happening, right? They announced stepping up from 2 to 4, so they're not targeting a number on the yield, right? Is it QE? No. They're not using the Fed. I mean, they may use some clearing desk or at the New York Fed, but this is a treasury operation. It doesn't involve the Fed for now. We are not using the Fed balance sheet. So it's not QE. It's not money printing going brr. Although, if you took the time to study QE, you would know at this point, after many, many years, that not even QE is money printing. It's just another swap in reserves. And you don't need me for that. If you can retrieve a famous interview that Jerome Powell itself gave out back in the days, it was, sure, central bank jargon, but he was talking specifically about changing the nature of a reserve, namely the duration in this case. Now, again, don't want to get into details about QE, but it's not money printing. The Fed prints bank reserves. The commercial banking system can actually produce money out of thin air. But the Federal Reserve, it's kind of not. Unless they, in that case would be the Treasury though, unless like in 2021, unless they helicopter money directly into households' checking accounts, or they mail checks to the post inbox. Other than that, it's not money printing 99% of the time, right? And it's not Operation Twist, because Operation Twist was funded selling short-term securities and buying at the same time long-term securities at the same time, right? To reshape the yield curve. But these buybacks that we are talking about now, they don't assume they're going to unload short-term securities. If anything, they may issue more, right, at the short end to buy back what they intend to buy back at the long end. So it's neither of those things you may have read about on social media so far, right? And if you want more evidences, right, that QE doesn't work in the sense, or at least the way they try to sell it out to you, the reader, the commoner, the peasant, right? What was QE in a nutshell? Beside the money printing, maybe yes, maybe not, whatever. But what was the aim of QE? To suppress interest rates. If you suppress interest rates, you're going to spark what? Lending activity. So credit creation. And since money is credit, we do live in a debt-based system, right? If you spark more credit, you spark more money, more liquidity to support whatever, real economic growth, so stimulus, or, in my view, a little bit more, asset prices, right? But did QE work? I don't know. If you look at these, every time they implemented QE, rather than suppressing rates, they went up. and they collapsed back down when QE was actually terminated. They did it in tranches, as you can see, right? So, I mean, I don't know. 1, 2, 3, every single time they did it, yields went up. Now, you may say, okay, maybe because the market actually bought in the narrative that it was actually money printing and they were expecting rather to be stimulative for the economy, or rather to be inflationary, whatever. Therefore, yields started to reflect that. Yeah, okay, but that also means if yields are going up, that the amount of selling, it's basically overwhelming the amount of buying that the Fed is performing. So who's winning? Again, kind of like with the yen, the market is winning. It's not the Fed. And when the Fed finally gets out of the way, the market kept on going down toward the original direction it was going. So it was more like the market was scared about a potential policy mistake rather than, the government getting the fuck out of the real economy and let the market play out the way it's supposed to be, right? So that was the QE era in a nutshell. Now, of course, people are worried about, and they say that Bessent had to do it because, if yields keep on spiking, the interest burden will be atrocious, impossible to bear, unsustainable for the US economy. Although, even in here, again, I'm not saying it's not going to be, maybe in 5 years, 10 years, who knows when, right? But just to give you a little bit of a perspective, even that narrative, if you look at that, and if you look at the interest burden, right, as a percentage of GDP, that's key, right? And it's not unprecedented. We've been there before. Late 80s, in the 90s, and early 2000s. And then what? Right? Now, why I think it is important to look at that as a percentage of GDP, right? Because let's say, let's bring the example back to yourself, right? Let's say you have an adjustable rate mortgage, right? And all of a sudden, rates go up, so your monthly payments are going to reflect that. So you're going to have to pay more and more every single month, right? That's a problem if your income stays the same. But if, when that happens, when the rate adjustment actually happens, you find a new job which is paying you double what you were receiving before as a paycheck, is it a problem anymore? If the amount of revenue, of income that you are generating is actually keeping up the pace with your expenses, net, at the very least, you are in the same situation as before. So is the interest burden on yourself as a household impossible to bear? No. At the very least, you may moan about the fact that you got a raise, but all the raise is absorbed by interest rates on your mortgage going higher. But you're not forced to sell the house, to relocate. You're not in default, right? So again, that's another type of consideration. You need to adjust the amount of debt and the amount of the debt burden, the cost of servicing the debt, to what the real economy, the global, the overall economy, national economy, not talking globally, but national, right? It's able to generate as an output. You can't leave the output out. It's like that video that I recorded about Milton Friedman when he was saying inflation is always and anywhere a monetary phenomenon. Yes, but the sentence keep on going, right? It's a problem if money supply grows much more than what the real economy can generate as an output. But if the output goes up at the same pace, at the monetary base is expanding, it's not going to be inflationary. It's kind of the same here. It's not going to be a problem up until the point the output, it's going up at the same pace, the burden, it's increasing. So is it a positive that we are back to record levels? No. Absolutely not. It would be way better if we were a bit lower than that. But is it unprecedented? No, we've been here before. What did it take to cure that problem? Oh, war popped in the 2000s. The dot-com bubble. And then 7-8 years later, GFC. And we got into the ZERP era. I give as granted that I take as a granted that you know what ZERP is, but zero interest rates policy for those which are not that familiar with acronyms, right? So again, it's not a positive, but it's not unprecedented, right? Bottom line. Then what? If you check at the long-term chart of interest rates, they are back to places where they were before the GFC and before the ZERP, right? So you could build up a case that interest rates are not skyrocketing, they're normalizing. And I'm going to give you an example right here. This is basically the 30-year yield with the candlestick, right? Then in red, you have the 10-year yield, and in black, the 2-year, right? Now, if you zoom out enough, you see that, starting in the early 90s, the yields, they came all the way back down. Oh, okay. Then we got this period of very low interest rates, all right? And we are back to where? We're back in this pocket right here, where we were in the early 2000s, right? Before the GFC and all that government interventions and all that distortions and dislocations with the, the central planners, the institutions that they applied to the market. Okay? Think about it this way. Because it's easy to say, well, rates are too high, I can't afford a mortgage on a house. If you were on the other side, would you lend money out for 30 years at 2.5%? I'm telling you, if you say, yes, I would, you're a fucking liar. You wouldn't. Because naturally, you're an intelligent person and you do know how many things could happen in 30 years, so duration risk, right? You do know that you may have way better alternatives elsewhere, opportunity cost, right? So why the fuck would you lend money to someone for 30 years if you are compensated for just 2.5, 3%? Not to mention the rate of inflation, if you want to break even with inflation. Who the fuck would do that if not who? The government. Because the Fed balance sheet is infinite and they cannot go bust. But at the same time, they create massive dislocations. One of which, house affordability. And it's counterintuitive again. Everyone is moaning about house affordability. Dude, you should buy a house when rates are higher. Because guess what? If it is supply and demand, what our rates would represent? If rates are higher, and as you say, and if you're right, it's harder to buy a house, what you would get at a point. Housing market prices going lower. Good moment to buy a house. Because of what? Well, you may say, well, okay, but initially, the monthly payments will be high. Sure, but the price will be lower, right? And maybe in a few years, 2, 3, 4, whatever, the first time we see a recession, you go there, refinance the mortgage at a lower rate so that you have locked in a lower than the average, recent years price for the house itself. And at the first chance possible, you refinance at a lower rate. So you locked in the lower house, the lower price house, and then you can adjust the rate later. Rather than what? Locking in a low rate on the mortgage, but paying extra, paying an obscene premium for the house, which at the end of the day, you couldn't afford to begin with. Right? Is it affordability? Back in the days, people had to come up with 20% down payment on the value of the house, and interest rates were 7, 8, 9, 10%. Now you need to show up with what? Up until, 2, 3 years ago, you needed to show up with 3% down payment, and interest rates were at 2.5%, 3% on a 30-year mortgage. And people were moaning about affordability. Look, if you can't even not put up the 3% down payment, it's not a problem of affordability. You have a financial problem that you have to solve. You shouldn't be allowed to buy a house on debt if you cannot come up with a 3% down payment in the first place. Which is why we got into problems with the GFC, because we lent money out to all people which were unworthy creditors. Right? That's it. So ideally, you would want interest rates to normalize, right? Because that's where they would naturally be, okay? And there is more than that. We can keep going. Look, so if you look, when you adjust for inflation today, rates are not that high, even compared to the GFC era, right? Not to mention the 80s and the 90s. So again, are rates really skyrocketing? Is it really unbearable long term or mid to long term? I don't know. I mean, surely it's worrying, especially if you consider the amount of leverage that there is in the system, both from financial institutions, but even households. How many households you see which are deep into debt? Auto loans, credit card debt, mortgage on the house. We've been living in an era where money was free. And now we are, after 15 years, we are finding out that, well, that's not normality, right? So, but look at that. If you're worried about the government going bust, right? Look at the comparison in between the beginning of the 90s and 2025. So nominal GDP back then, right? 6 trillions, more or less. Now it's almost 31 trillions. The debt, sure, it went up, 3.6 trillions. This is not up to date, I guess, because just this week we breached the 40 trillions, right? It is maybe 1-2 months old as a screenshot, okay? Debt to GDP, it was 60%. In early 90s, it's 120%. I think it should be around 122 right now, the last time I checked. But again, just rounding error, right? Net interest outlays, 194 billions back then, almost $1 trillion now. But if you check at the net interest as a percentage of GDP, it's basically the same. Again, because the economy grew, right? So the implied average rate paid, it is actually lower now compared to back then. Which again, one of my concerns, and again, you gotta be honest, you gotta be transparent. And again, I'm on the record saying it. If you check my videos back, I was saying, look, if you see yields starting to creep up above 3.5%, you're gonna need the Fed to step in because the economy would implode. It didn't happen. I was wrong. It didn't happen. Right? Little bit I knew back then, 2-3 years ago, but it didn't happen. And now, with a little bit more of experience under my belt and a little bit more research, you can kind of grasp why. Again, that doesn't mean that everything is rosy and you should live like Pollyanna with rainbows and unicorns, but at the same time, it doesn't mean that the end is near, if you remember the GIF, right? Or the GIF, right? But, keep on going, there is more, right? Why is the debt a problem? Because everything and everyone, it's fixated on the debt. The debt is a problem in the sense that if all economic growth we have seen over the last 15 years was fueled, for the most part, not entirely, but for the most part, by debt, the debt has a negative multiplier, right? And here you can see, right, the amount of money, public money, that you need to spend in order to generate $1 of economic output from the real economy. It's a little bit better than what it was in the previous decade, but compared to the pre-crisis and the prior to the ZERP and all the rest, it's way worse, right? And again, if there is a negative multiplier and it takes more and more money to generate less and less growth, relatively speaking, sure, the debt is going to keep on going higher, but the result will be way, exponentially lower and lower and lower. So the real economy will not be as good as you would imagine by just looking at the sheer numbers of, so quote-unquote, stimulus propped up by the government. And again, what happens, again, try to think about it as if it was yourself, a household, an individual, right? If you spend money now to fund your consumption, let's say you use your credit card, right? At a point, you're going to reach the limit. So maybe you take another credit card and you start to max out that. You're going to live like a king for maybe 3, 4, 6 months, but then all those old payments will come due. And if you don't have, as the example before from the mortgage in the house, if you don't have new or increased generated income, what you're going to do? It's going to be a drag on your budget. no more vacations, no more restaurants, up until the point you pay down that debt. Your standard of living as an individual will need to come down in order to service that debt. I mean, you could go delinquent, but at a point, you would lose access to pretty much every single form of credit, and you would be destroyed financially, I guess. So, hard choice, right? And it's kind of the same with the government. The burden of the debt is going up. That just means that the government will have less and less money to be invested in what? Productive investment, right? Those things where the government can spend money now, but they're going to boost up the returns. They will be a positive drag on the economy in the future. Like, I always think about the Hoover Dam, right? The entire project. And you look at the amount of revenues to the government, which was generated in the following decades from that simple infrastructure project. But if you keep on spending money to, conduct, I don't know, to pay Social Security, to pay Medicare, to pay this and that program, childcare, whatever. Sure, at a point, the bill will come due and you're not generating revenues. Every single program, at least, lately, over the last 20 years, I would say, and again, it looks like I'm ranting against the US, but it's kind of the same in the whole Western civilization. Even where I live, subsidies everywhere, which oftentimes they're just used for politically aims to buy votes, right? But they are a negative drag for the next decade on the same people they claim to help today. Yeah, you help a bracket of the population today for 6 months, 1 year, and you condemn them to financial repression for the next decade. Is it a good deal? No. But everyone is voting for it. So, as Churchill was saying, democracy is terrible, but it's the best we got, right? So what are you going to do about that? Now, moving on, again, I got more. So here, this is why, if you see, it's the same chart expressed on a much longer type of chart in a different format. But if you see the debt going up and up and up and up, and what do you see? GDP is going down, right? Now, sure, okay, you may say in here, right, we really went crazy with the debt and GDP, we get the bounce, reflationary bounce out of the pandemic. And after that, what? We are basically down to the same baseline we have been for the majority of the last 50 years. The debt is still growing, right? But don't expect this line to keep on going down, right? So it will take more and more of this red line to generate $1 of economic growth, with the same problems and implications we just talked about. Different context, but, every single cycle, the growth which was generated and the total of debt, the totality of debt as a percentage of GDP, again, skyrocketing higher, right? So the problem with the debt, it's not the fact that the government will go bust, right? The government will default. It may happen or it may not happen. I don't know if and when it's going to happen. But the most pressing problem for real people in the real economy, this is the one. It's the standard of living. It's going to go down. Especially, again, for the lower income tier of the population, right? If you're packed with money and you can afford to buy stocks, to buy whatever, you're going to laugh at it. Bring me more inflation, bro. If my stock portfolio is going to the moon, give me more inflation, absolutely. But if you're not, then you're fucked. And then again, always be particularly not worried, but careful with what you ask, because at the same time, it's easy to say, well, just cancel the debt. Or at least, stop being a drunken sailor. Easy to say. You guys tried with Doge, right? How did it pan out? Not as expected, right? And moreover, since we are at this point now, this is what your real GDP growth would be if you wouldn't have the debt. When this red line starts to go down, these are people losing jobs. These are people losing houses. These are people going into default. These are people losing the ability to put a roof over their head and food on the table. Now, you may say, I would take it. If it takes 2, 3, 4 years of that in order to guarantee ourselves another 50 years of economic prosperity, I would take it. It's easy for you to say, as it would be easy for me to say, but I don't want to be an hypocrite. I know there are a lot of different people, even in my own country, which would never vote for this. Because at the end of the day, we're humans. And we look at tomorrow or next week. We cannot, biologically, we cannot think 3, 4, 5, 6, 10, 20 years ahead. It's just in our nature, right? So we are structured like these. The politicians in charge, which are trying to grasp our votes, are basically on the opposite side. They are willing to make that deal in order to stay on their chair. So this is how it's going to go, most likely, or at least for the foreseeable future, right? Now, again, still on the topic of, well, yields going up, the debt is going to implode, the government will fail. This is a chart of the term premium, right? So basically what the market is charging on top of what the normal yield should be or predicted to be because of what? Well, because they anticipate inflation or they want to be compensated a bit more to hold public debt, which supposedly it's going to be less and less safe to hold, right? I mean, if you check from 2023, that term premium actually came down, not up. So, I mean, it's the bond market really starting out a revolution. Are the bonds vigilantes back? I don't know. I would expect term premium to go massively up. Same as if it was a problem of inflation, I would expect, the 2-year in black to really skyrocket, even more than the 30-year, right? Because, inflation should be felt even more in the short term. So I keep on having conflicting opinions on this, or at least a few doubts and reservations. Now, at the end of the day, it's true what they say. Predictions are always hard to make, especially when they are about the future, right? But again, I'm just trying to give an opposing view. And I think one of the main example would be this. Now, starting from the top, right? This is a 10-year yield. And as you can see, as we've seen on the trading view chart, it's going down and down since basically the great inflation in the 70s, right? That everyone is so, calling out to come back again now. Okay. But if the problem is the debt, right? Why in the same amount of time, the debt was skyrocketing and yields were coming lower and lower and lower? And just now, they're going up and up and up. I don't get it. Why? Why this wasn't a problem for 60 years and it starts to be a problem now? Now you may say, okay, but we now reach the point of no return. But my counter would be, you say that now because you have the benefit of hindsight. Let's say you were in the 90s and you see the debt going from, call it 2 trillions, up to 8 in 2008. Now, why this didn't happen in here? While the debt actually doubled in, basically 15 years. Considering that from 2008 to 2020, so another 15 years or so, it not only doubled, but it went from 8 trillions up to what? 40. And this is, throughout this period, yields kept on going down and staying down. I mean, again, you may say, but it's the Fed intervening, it's all the monetary policies, the distortions, the manipulations. Yeah, but as we've seen on that QE chart, it don't work so much as you expect usually, right? So why can the market overwhelm what the central planners would like to see in the short term, but for some reason it can't do it in the long term, right? So again, I guess, it doesn't add up to me. And again, if you don't want to be focused on the debt, just focus on the deficit, which again, with, beside that tiny little parenthesis in the late 90s, it grew bigger and bigger and bigger. But, the yields kept on going down and down and down up until 2021, 2022. And, here's the thing. If you take a chart of nominal GDP, so growth, essentially, and bear in mind, nominal, it's including inflation, right? Otherwise, it would be real. So it's taking into account inflation. It's included in the calculation. I mean, it's not one-to-one, but it looks to me like there is a good enough correlation over a long enough period of time in between the 10-year yield and the nominal GDP. Is it just another testimony that at the end of the day, yields are just a reflection of growth and inflation expectations rather than the debt, the deficit, Bessent needing to intervene in this and that? I don't know. It seems like that to me. And then you have the other side of the coin. If it's not about the debt, if it's not about the government going into default, well, there must be some sort of a exhausting valve somewhere. So if it's not the debt defaulting, how can they prevent themselves to default? Well, they are going to inflate away the currency, so the dollar will lose reserve currency status. It's going to lose purchasing power. It's going to be debased. Okay, which is true, by the way. The dollar in the US, it's losing purchasing power every single year, same as any other fiat currency in any other nation. My euro, it's losing purchasing power every single year. The British pound, the Japanese yen, God forbid. Look at the charts, right? Everything it's losing it because it's fiat money, right? But, is it losing reserve currency status? So if you look at the percentage, the share percentage of the US dollars as foreign exchange reserves, yeah, sure, you could say from the 2000s it went down. Now, in these, there are a lot, of different caveats because from the 2000s, you had the euro being established, which one way or the other, it subtracted a little bit of that. Because again, think about the 20, there were initially 20, maybe 20, and then they brought it up to 27, European Union member state, right? If all of these states, which by the way, are a good chunk of the global economy, right? If all of a sudden, in order to trade with each other, they start to use a common currency, the euro, instead, as maybe it was before, transitioning to, using the dollar as a minimum of exchange in between the German mark and the Swiss franc or the French, what the fuck did they have in France? I don't even remember. Or the Italian lira, right? Whatever. Or the British pound. Well, no, the British pound is not a good example because they never entered the monetary union. But again, you got the gist of it. If all of a sudden, instead of using the dollars to move funds from Germany to Italy, from Italy to France, from Spain to Germany, whatever, we can use a common medium in between ourselves in Europe, we are going to subtract a few volumes from, the dollar circuit. And in between each other, right, we are going to hold a little bit more euros rather than dollars, right? And then you got what? In 2010, you got China entering the WTO. So again, although China actually was a major participant in the dollar system, when an economy grows that big, it's normal that at least regionally, a few trading partners will hold maybe a little bit more of that particular nation currency because they are trading a lot in between each other, right? So, overall, as a percentage of the total share, it came back down. So maybe it's not anymore a reserve asset. And then you got the entire thing with gold, central banks actually ditching the treasuries and buying gold. So yeah, okay. But how do you define a reserve asset? Is it what you keep in your money piggy bank? Or is it what you use the most? in order to actually transact. If you look, I mean, I think this is a BIS, so Bank of International Settlement. Looks to me in red 2025, so it's up to date to the end of 2025. Compared to 2022, it's the foreign exchange market turnover by currency. So it's the usage of the dollar down or up. The vast majority of cases, it looks to be up. So in order to transact, to settle, in order to actually entertain trading relationships, are we using more or less dollars? So again, when it comes down to the talk about dollar dominance, it's the dollar more or less dominant. I don't know. And then again, this is another one. And again, here they are doing the same thing, that they're excluding payments in between the Eurozone because, of course, we use, in between ourselves, we use our own currency now, common currency. Fuck that. Still, even if you account for that, 82.5% in trade and finance market are still, all those transactions are still using the dollar, right? This is the narrative is that, the world, it's not using US treasuries, or which are basically just another term for dollars. If you think about a treasury, what's that? It's a dollar with a different type of duration, which is also paying you a yield at the end of the day. But it's a dollar asset, right? So the narrative is that the world is shifting. And again, I truly believe that. I do believe that the world is preferring to hold or to differentiate, to diversify away from US treasuries, right? Mainly because what they've seen happening with Russia, okay? So I'm not disputing that. I'm just saying, what is gold at the end of the day? Is it just another proxy for dollar liquidity? In the sense that if you ever need liquidity because maybe there is a liquidity crisis or whatever, or for some reason your balance sheet is upside down and you have a lot of dollars liabilities, as the world has, to be fair, you can just check the amount of outstanding dollar denominated debt in the world, excluding the US. So the amount of debt that the rest of the world owe to itself, different participants, excluding the US, owe to each other, right? If you have a problem like that and you need to liquidate your new reserve, which is now gold, gold is priced in what? Dollars. So if you need to pay down your liabilities and you need the dollars because they are denominated in dollars, you're going to sell gold to get what? The dollars. So isn't it gold just another way, another proxy to dollar liquidity, which has the huge advantage for you, non-US resident or institution, which cannot be confiscated with a click of a button by the US government? Yeah, I think it is. But the necessity is always to have some type of dollar liquidity pronto, ready very fast in case I need it. And that's from the central bank or the nation states, governments outside in the world perspective. But if you look at the private sector, if you look at enterprises, corporations, multinationals, I don't laugh. I made it this morning. It's just a sketch. But if you think about a company, right, and you look at the asset side of the balance sheet and the liability side, you may have different customers because you are a multinational, right? You could be, I don't know, you could be Mazda, or you could be Temu in China, or you could be whatever other, you could be Volkswagen or BMW or Mercedes here in Europe, right? Whatever, it doesn't really matter. You could be Aston Martin or Rolls-Royce in the UK, whatever, it doesn't really matter, right? But you may have many different clients or customers from all over the globe. They pay you with the currency. It may be euro if they are Europeans, it may be Japanese yen, it may be CNY. So you have your assets, which at a point are denominated, right, in a currency which is not the US dollar. But your inputs, let's say you need to buy raw materials or energy like oil, gas, whatever, or copper or silver, whatever commodity, right? For the most part, to this date, they're all priced in dollars, right? Now, you may say, okay, but then what if the supplier may invoice me in another currency? Sure, but that would require the supplier himself to be able to, have his own side of the balance sheet, where on the liability side, he would be invoiced in another currency, which is not the US dollar. So the entire system would need to shift in that case. But let's stick to the example. All your liabilities, all your costs are denominated in dollars, right? And you could substitute suppliers with, I don't know, debt. Maybe you have long-term financing in order to fund your operations, whatever, right? But still liabilities denominated in dollars. If you accept other currencies, right? And as you can see in here, they can fluctuate, right? Relative to the dollars. What could happen is that, let's say the dollar goes up against the euro, the JPY, as it actually happened not that long ago. It means that the liability side of your balance sheet is going to go up and the asset side is going to go down. So at a point, you take the chance of carrying a negative equity, right? You're upside down. So what a lot of companies actually do, they take that currency that the customers are paying in, and they swap it for dollars, right? So that can match up the assets and liability side of the balance sheet, right? Because remember, and I didn't even know that the yen and the Chinese renminbi actually has the same symbol, but apparently, standing to Google, that's it, right? Or, when you have to hedge these currencies against the dollar, you have a lot of tools. You could use interest rate swaps, you could use FX swaps, you could park a bit of those money into the US capital markets, so buying treasuries, because at that point you're also collecting a yield, right? And you don't take, if the liability side and the asset side are matching up and they are both denominated in the same denominator against, again, the dollar, you don't have FX risk. It's way easier to manage FX risk if you use the dollar on at least one side of the transaction or the balance sheet, because you have many more tools. Try to go and do an FX swaps or an interest rate swap spread in between, I don't know, Mexican peso and Australian dollar. Probably it's not going to be as easy as if you had the dollar on one side of the transaction. I'm not saying it's impossible, but it's not as easy. Maybe you would need to contact a bank and setting up a specific contract or a specific instrument to do that, and they're going to charge you a premium for that. What is the ultimate goal of all these private sector companies or multinational actors? Profits. So if I can find a way to manage my balance sheet in a way which is less cumbersome, more efficient, and cheaper, I think I'm gonna go with that. Right? This is why the centrality of the dollar dominance, although you can argue the reserve currency status, it's so hard to defeat. Right? Because you would need to build up an entire new network, an entire new framework, an entire new pipeline, a plethora of new instruments, which will allow, with the same amount of efficiency, of seamless transactions and cheaper cost, to perform the same, to fulfill the same goals that the dollar system is actually allowing you to do right now globally across different jurisdictions, different countries, different economies, and different financial systems locally. So again, at the end of the day, when people look at these and say, the dollar is doomed, the US government is defaulting, it's broken, is it? Maybe. Maybe it's going to be one day. Is it the day? I don't know. Nobody really knows, right? Ray Dalio, it's calling it from it since 1992. And remember, Ray Dalio, it's no stupid, right? And yet, it's been wrong 35 years. So, could I be wrong? Maybe Monday morning I wake up and the entire financial system is collapsed. Maybe. Who knows? But, you know, at the end of the day, forgive me, if Ray Dalio was wrong for 35 years, can I be wrong just one time? Right? And with that, I guess at this point, I really diverged. I really went off of many different tangents, and the video is probably 2 hours long. But again, last week it was just 47 minutes, so I needed to catch up. And to to cast a little bit of clarity, to cast away the shadows on all these social media derangement about Bessent stepping in, right? So with that, I'm going to leave you off, wishing you a very good rest of your weekend, a very good start of your next week. And as usual, just remember, be nice and be cool. Nils out.
Mm-hmm. Mm-hmm. Mm-hmm.